Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's episode, we're joined by Will Matheson, Matheson Capital. Based out of South Carolina, Will and his twin brother run and own Matheson Capital. They currently have over $100 million in assets under management. And today we're going to hear about Will's journey from starting as a broker with a commercial brokerage and turning that into a multifamily syndication that owns over $100 million in real estate. Now let's welcome Will Matheson. All right, Will Matheson joining the Westside Investors Network podcast today. Will, thanks for hopping on and chatting with us.
Thank you for having me, Trent.
So Will Matheson is a co-founder of Matheson Capital. You want to give a quick shout out to Matheson Capital and your guys' business?
So I run Matheson Capital is a real estate investment firm. We're based in Charleston. We own in North Carolina, South Carolina, Georgia, and Alabama. And we've been buying since 2018. Run it with my twin brother, Evan. That's the short version.
I love it. I love when brothers work together in real estate. That's how our company started. Not my brothers, but two brothers started Uptown Properties. And I've seen how the family brother relationship can work in real estate. So that's awesome. So Will,
it's been great.
You and your brother obviously partnered for this real estate journey. Did you guys have the same, launch pad or process to get into real estate, or what was your journey to get into real estate?
So, by virtue of being twins, we have had almost entirely the same life experiences outside of, we went to different colleges, and out of college, Evan started working as a mortgage broker in for Marcus Millichap in New Jersey. It took me a while to really find a job after college, but he ended up helping me get a job at Marcus Millichap in North Carolina. A few months into that, he moved from New Jersey to North Carolina. So we were both brokers at Marcus Millichap, doing retail primarily with a little student housing, a little multifamily throughout the Carolinas. And, we did that for a while. We were on the top team, not the lead agents, but the second and third on that team. I want to say we did at least 50 investment sales transactions during a 2-year period. And then we left early 2017, we left Marcus Millichap. We went to Columbia University for their master's in real estate development program, 1-year program. And while we were in that program, that's when we started buying. And that's when we started buying real estate, in part because one of our classmates found an opportunity that we thought was pretty good. Back in North Carolina, we had actually placed a hard money loan. That was the founding of Matheson Capital. Had an investor, 1031 exchange, shortfall. They needed $1 million quickly. So we thought, why can't we raise it? Gave us some confidence. So then when one of our classmates was looking to buy an $800,000 property, they needed some partners. Evan and I got involved. Closed that first deal January 2017. And that gave us, the loan gave us confidence, but doing that deal gave us a lot of confidence. And we eventually said, look, it's honestly pretty hard to find jobs right now. When we go out and try to build our own portfolio, raise money from investors, we'll start small, we'll scale it up over time. So it's a very long-winded way of saying how we ended up here.
I appreciate it though. So you started with the duplex. I know you were brokers at Marcus and Millichap. Did any of those experiences, I'm assuming yes, but what experiences from Marcus and Millichap showed you and your brother that you can do this on your own?
So the first the first experience that really showed us that we could do it was placing the hard money loan. Like I mentioned, back in 2015, it must have been around August 2015, one of our investors had a very big 1031 exchange. And instead of doing all of it into one property, they split their exchange. And 30 days or so before closing the second of the two properties, the lender said, hey, look, we're only going to give you this much money, left them $1 million short. But because we had worked with them so many times, or I should say our team had worked with them so many times, we knew their full schedule of real estate. We knew they had strong personal net worths, things like that. So when our boss tasked us with going to find a hard money loan, we made a few calls, but then we were talking one time and we said, why don't we just go and try to raise the money? And that's what we did. That's what we did. And that was the first that doing that gave us, a lot of confidence in terms of, hey, we went out, we found money for this project, we put it down, it was successful. We held the loan for like 16 months. And the other thing that I always say about being a broker and working in Marcus and Millichap is it has a few advantages in terms of getting into the ownership side of things. One is you are getting paid to learn more and more about real estate. I don't think it's controversial to say when you're, 23, 24, you don't know a ton about what you're doing all the time. I don't think that's a controversial opinion. So essentially getting paid to get an education on, which investments are working out, good pricing, underwriting, all that stuff, it's really helpful. And as it pertains to what Evan and I do now, cold calling, cold calling for a job and just dealing with the constant rejection really translates nicely to raising equity because you will get rejected by a lot of investors who say, no, I don't want to work with you. No, go get more experience. No, I don't like this, that, or the other thing. But you just keep picking up the phone and asking. And that was those two things, or those three things, really all paid big dividends for us.
I love the cold calling piece because I agree completely. I also like how, you were tasked with this issue or problem and you had to go solve it in a short amount of time. And instead of, just putting your tail between your legs and running away, you put your boots on and you went and figured it out, which I think is a very good skill to have in real estate, especially on the investment side, because most of the time you're going to have to solve problems. So I love you bringing that up right there. And then the third thing is I feel like it's a lot, I don't want to say easier, but when you are getting paid to learn more about real estate, it's a lot easier to transition into where you guys are now instead of, going and being an engineer before real estate investing, because you're getting those skills that you're going to actually put to use when you do go out and start your own capital company or investment company.
Yeah, I mean, I will say you see quite a few people, who have been in like the medical field or some other field where they have a really good network and they do teach themselves the real estate side of things when they're getting into it, which, I'll be honest, it's incredibly impressive to me. We had kind of the opposite perspective where we got a really good real estate education from work, but I'll be honest, the network, we didn't build much of an investor network by being brokers because when you're a broker, you're talking to a bunch of owners who are used to owning. They're not used to being limited partners. So we've only had a handful of people from our brokerage days come in as investors in our company today, but like I said, there's always trade-offs. There's always a trade-off, but we got the educational part of it.
So after the duplex, where did you guys go from there?
So I can go as we talked before this started. I can literally go deal by deal in. So the duplex was January 2018. We bought a 6-unit deal in May of 2018. Both of those were sold by the end of 2019. We bought another 6-unit deal, January 2019, 15 units, February 2019, 24 units in December of that year. Then we bought 32 units in, I want to say March 2020, another 32 units in September of 2020, and then 69 units in March of 2021. So that was that was really the start of all those properties I just listed. We only own one of them still. All the rest of them, the longest hold period I think we had was 26 months or 28 months, something to that effect. We were really focused on short-term hold periods, buying, selling, adding the value, delivering returns back to investors so we could show future investors that nice full cycle. We took this deal from start to finish. This is the return we realized for our investors.
So, I mean, the unit count that you just listed out for someone that is wanting to get into larger multifamily, aka above 4 units, it sounds like you snowballed pretty quickly. Two questions for you. One, how did you do that? And two, why did you do that?
So, okay, a lot of reasons there. How did we do it? I am a big it's like what people say about having your first job being your most important job. My general philosophy has been that if you don't own anything in real estate and you want to go out there and buy it, if you go to the broker who's listing the $20 million property, they already know everybody who owns other similar sized properties in the market. And you have no track record. So the only way you're going to win that is by getting really aggressive on terms or overpaying. But if you start buying smaller assets, you buy that 15 unit deal, the 30 unit deal, that does give you credibility when it comes to buying the bigger deal. And it's also generally a less competitive area of the market. Oftentimes, maybe this is no longer the case, but oftentimes it's the most inefficient part of the market. So you can do the most in terms of adding value in those spaces. So yeah, that's why we started in that space. In terms of how were we able to scale, that was, I mean, part of that really was the fact that we held the assets for such a short amount of time. We were able to go to the investors who invested with us on our early deals and say, hey, look, we did this deal. I took it from A to B. Here's my next project. Do you want to join me on this one? Do you have anyone you would recommend I work with as well? Do you have any friends who might want to invest? So that was all a part of the strategy.
Yeah, it's interesting that you bring that up because, like our deals, for example, we're holding for, I think the shortest one we've held is at 4 years now, maybe almost 4 years. And with you churning and burning that quickly, a lot of people might think like, why are they just flipping all these deals? But you were able to show your track record, and those investors got their returns so fast that I feel like they were more willing to refer their friends to you guys. Am I wrong?
Well, I definitely think that helped. I mean, there are other reasons in it too, and we were very upfront with our investors about this. Like when Evan and I started, we did this full time. We got rid of our brokerage licenses. We said, we burned the ships. We said this is what we're going to do, which was a huge step back financially. We made good money in brokerage, but when you buy $1 million deal, the acquisition fee isn't really doing a lot. So part of the quick movement was to generate acquisition fees, but also generate promotes. And like I said, we were very upfront with our investors about that. We had an incentive plan. The higher the IRRs we could get, the more returns we could get. So that was definitely a part of it. And yes, to your point, today, when we work on projects today, we really do put more of a focus on cash flow and consistent dividends to investors. But when we got started, our philosophy was the way that we're going to grow this company and grow the size of our investments is not going to be by telling a new investor, hey, we've made our quarterly distribution the last 12 quarters. We wanted something that was going to jump off the page a little bit more of, hey, our LPs are getting a 40% return in a year. And we think that worked out. But like I said, we do put more of a focus now on that long-term 3, 5, 7 year hold cash flowing asset.
Yeah. And I want to go back to this I guess goal that a lot of people have of going from 2 units to a 15 unit building. In certain markets, that price point is higher than other markets. And so for a lot of people, when they hear 15 units, that might be $2 million, $3 million. How would someone go about getting to that 15 unit level if they think that it's just not feasibly financial or financially feasible?
So from very early on, we were working with outside investors, which obviously makes scale easier. If you can raise money from other people, you have more resources to deploy elsewhere. So that's a big part of it. But being direct and going back to the backstory, I was telling you, Evan and I, we spent a year in New York in grad school, and we left New York in part because we said to ourselves, we're 25, we're 26 when we graduated. We're not going to be able to raise tens of millions of dollars. This isn't tech. People don't give tens of millions of dollars to 25-year-olds. We need to go to a place where the money will go further. So, we started buying in the Carolinas, which are they're very good markets. They're very in demand, but it's not, $1 million in our 15-unit deal in South Carolina cost $1.15 million. In New York, maybe we'd be lucky to get a duplex with that money. So, two ways to get it. If you want to get more scale, you can go to where price, the same price, you can invest the same amount of money, but it's a lower price per unit, or you can raise money from other people.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. That's great advice. And then my follow-up to that is, I know you said you were based out of the Carolinas, still are based out of the Carolinas, South Carolina to be specific, but you invest all over the Southeast, and different markets, different states. How do you go about going to a different market, getting into a new market as an investor? If you want to make that, maybe someone wants to make their money go further, so they need to identify a new market. How do you make that happen?
So from 2019 through 2023, we invested in North and South Carolina. Those were our primary areas. I was raised in South Carolina. I've lived in South Carolina since 2018, but from 2014 through 2017, I lived in North Carolina, and that's where I was doing brokerage. So I got exposure to pretty much all of the Carolinas markets during that time. So that is where we focused, and we were able to invest in those markets because we were able to build really good relationships with brokers, so that most of our acquisitions were off market. We weren't in bidding contests. As far as expanding outside of the Carolinas and picking up new markets, a lot of that had to do with just building more and more of a reputation. The first place we invested in Georgia was Savannah, Georgia, which is only 2 hours from Charleston. Quite frankly, it's closer than any North Carolina market we'd been investing in for the last 5 years. And the Alabama acquisition was really just it was an opportunistic acquisition. And though we had never worked with the broker on that deal, we were well known to them and some of their teammates outside of Alabama, but their team in North Carolina, South Carolina, and Georgia. So that really helped us do that as well.
Okay, so kind of developing that regional relationship with these teams and these brokers and brokerages that are servicing those areas.
That's a much more succinct way of putting it.
Because I have people that I've talked with in the past, and like we're in Portland, Oregon, so it's not a cheap market by any means. It's not crazy expensive, but it's definitely not,
It's pretty expensive.
Yeah, it is. But it's, a lot of our people that I know here, they want to get to new markets. We want to get to new markets. And so the biggest challenge that we've seen is developing those relationships with brokers where they're taking us serious, even though we have a pretty good sized portfolio here. sometimes it's hard to build those relationships even when we have a $40 million portfolio, you know?
So I'm gonna drill in on that a little bit. I'll drill on that in multiple ways, going back to our Carolinas acquisitions. So the first acquisition we did in South Carolina was a 15-unit property in Summerville, South Carolina. The next acquisition we did was 24 units in Charlotte. Funny enough, in 2020, one of our 32 unit acquisitions was also in Summerville, South Carolina. The broker on that deal did not realize we already owned another asset in that market. He didn't know that, but he was aware of the fact because he knew the seller. He was aware of the fact that we had bought 24 units in Charlotte. So that even gave us credibility to buy the asset in Summerville, South Carolina. Summerville, for those of you who don't know, is part of the Charleston MSA. The acquisition we did in Savannah, Georgia, was from Berkadia. Berkadia was the broker on that deal. We had bought a deal in 2023. We bought deals in North Carolina and South Carolina in Berkadia, and we closed on the Georgia deal with Berkadia in 2024. And the Alabama deal, that was brokered by Cushman and Wakefield, who I have been talking to Cushman and Wakefield since 2019, but I had never done a deal with them. Actually, probably 2018. But they're aware of who we are because we've been active in the market, in the Southeast market more broadly. So, we did have some credibility with them. One of the things I always tell people, though, is when it comes to markets, and, you're based in Portland, you're doing a lot of stuff in Portland, where are you looking to expand specifically? Like, which market is next, like Seattle or something like that?
No. We want to get to a more business-friendly state market, southeastern region. I personally like the Midwest, but my partners don't. But, a state or an area that is less tenant favored and, because we get kind of handcuffed with the landlord-tenant laws here. And it's just not very business-friendly.
Do you have a specific market you're targeting?
Yeah, I mean, we've looked at Georgia, we've looked at Florida. I'd say Georgia's probably higher on our list than Florida now, but Georgia is one example.
Yeah, so one of the things I always tell people is it's better to have a network that's a mile, or I should say an inch wide and a mile deep, than it is to have one that's a mile wide and an inch deep. I know plenty of groups that, they'll get on every major brokerage's mailing list, and every deal, it could be in California, it could be in Omaha, it could be in the Northeast, it could be in the Southeast. They want to underwrite it and talk to the broker and all these things. But speaking as a former broker and a guy who talks to brokers all the time, if you're just calling, once a month, once every 3 months, it could even be once a week, and it's like, hey, I want to know about this deal. Hey, I want to know about this deal. Hey, I want to know about this deal. But you don't own anything in the market, they're going to forget about you. They're not going to give you too much time a day. And that's not a knock on brokers. It's just they receive a ton of these calls. So when we got started, we were focused specifically on the Carolinas. And that focus, like I mentioned, that's what allowed us to get the deal in Georgia. And that's really what allowed us to get the deal in Alabama as well.
And I know earlier you mentioned, and I've heard this plenty of times, but when you're new and just starting out, a lot of brokers aren't going to give you the time of day unless you have favorable terms or you overpay for it. How are you able to accomplish that first deal in Carolina or in South Carolina without buying a bad deal?
So funny enough, the first acquisition was in the first Carolinas acquisition, January 2019. That was in Boone, North Carolina. And I actually bought it with the help of my former boss and his team. They were the buy-side broker on that deal. But the first acquisition we did in South Carolina, we bought for 1.15. I actually had it under contract at 1.25 a few months before we bought it, and I terminated the contract, and it came back around. So the first time I think we were going to overpay. But the honest answer is that deal was on the MLS. It wasn't on LoopNet. It wasn't with a major firm. Like, it wasn't with the CBREs or Cushman and Wakefields of the world. We found it on the MLS, which I think is a great place to go. Sometimes the properties will be terribly overpriced. Sometimes they'll be priced right, but sometimes they'll be underpriced. It's really about finding the least efficient point in the market. And most people who are trying to buy multifamily aren't looking on realtor.com. They're looking on LoopNet, they're looking at all the other sites. So, that obviously helped. But another thing that's worth pointing out is when you're dealing with your Berkadias, your CBREs, your JLLs, they're typically doing a whole, full marketing process, tours, call to offers, everything like that. If you're dealing with oftentimes LoopNet or MLS or Realtor.com, it's coming on a first come, first served basis. Like they're not running a strict process. So you're often not put in that position where you need to outbid everybody else. You just need to submit an offer and start engaging with the seller.
Out of all the times that I've asked that question to people on this show, that's the first time I have heard someone mention the MLS and going to the MLS. And I don't know how I haven't said that before, because we've actually purchased deals from the MLS in the same
Well, you're
fashion.
trying to keep it a secret,
Yeah. But that is great insight. And it's something, like I said, we haven't talked about before. It's something we've done, but instead of just going straight to the heavy hitters, the JLLs, the Cushmans, all those, go find someone that can give you access to the local MLS and see what pops up. That's a great idea.
I mean, Realtor.com will give you access to almost the whole of the MLS. The first two acquisitions we did in South Carolina were essentially listings from residential real estate agents or commercial agents at residential real estate firms, which you do run into from time to time. And I think that's a pretty favorable place to be if you can bring a certain level of sophistication to it. I don't mean that as a knock, but it's like I said, I've seen plenty of properties there that do sell at good prices. We just happen to think that we got pretty good acquisitions on those. And to be honest, there was a period for probably 4+ years I was signed up for like realtor.com alerts for 10 different markets throughout like Raleigh, Charlotte, Savannah, Charleston, Charlottesville, Virginia. Like I had realtor.com notifications for all of those markets. And every now and then you'd see a good opportunity and you might not win it. But I wasn't going to see it otherwise.
Yeah, no, I said, that is great advice and a great strategy to deploy if you're wanting to get to new markets on that, smaller unit count level. Well, I have a question for you in terms of your value add plans, and we don't have to hammer too far into it, but I know you invest in value add real estate. What does a typical value add plan look like for you on this, 5 to 70 unit project that you've worked on in the past?
So I'll be pretty direct about that. We don't reinvent the wheel for the most part. I know a lot of groups go in there and they're like, we need to completely redo the exteriors. We need to rename the properties. We need to do X, Y, and Z. When we were doing our early stuff, our approach was essentially, we're going to buy the place. We're going to focus pretty much all of our efforts on doing interior renovations, new flooring, repainting it, countertops, appliances. Again, not rocket science by any means, because those are the things that are going to have the most, they're going to instantly drive the value. It's, you can tell when a property hasn't been renovated since 1976. You can tell, and it really drives rent a lot when you can go out there and show renters like, hey, look, you could have this old dated brown wood interior that looks like, that 70s show, or you could go with, this nice new stainless steel, et cetera, and it's going to cost you $300 more or whatever the price difference may be. And people go for that. But we didn't reinvent the wheel on that stuff. And, if we could avoid it, we were going to avoid doing like down to the studs, replumbing the whole property, things like that.
It's interesting that and I mean, I agree completely with that. If a property hasn't been updated since, the 70s, 80s, is there any focus on exterior and curb appeal and that kind of thing?
Some assets we did that, others we didn't. I remember one property, we went out and we were like adding dog parks and we renamed it from Central Quarters to Central Oaks because I thought Central Quarters sounded like a prison. Yeah. But no, by and large, I mean, when we were getting started, we were just very We were just very internally focused. Now, I will be honest, we probably would have been better off doing some of the exterior work. I've seen some of the assets we've sold, they've been repainted. I don't know how much they drove the rents, but property sure does look better from the street.
Yeah. Well, and I appreciate that because, everyone has a little bit different strategy when it comes to value add, especially the construction piece. What about the operational side of value add in terms of management, rubs, utilities, all that stuff? Were you focused at all on that?
I mean, we obviously cared about it. I'm torn as to whether or not I regret this. Some days I do, some days I don't. From the very beginning, we were hiring third-party property managers. And there is a part of me, at least for the assets we owned in South Carolina, part of me wishes we'd owner manage those because you would learn so much. And let's be honest, it's a way to supplement your income when you're getting started. But we always used third-party property managers. Not too much to say about that, really.
Yeah. And that's I feel like it's kind of 50-50 when you're starting out, whether you're hiring third party. I know a lot of people that maybe aren't full-time in this business yet. They are hiring third party, and that can kill deals sometimes. So that's why I brought it up to see if it didn't hurt you guys too bad to hire third party managers.
I mean, I've fired people, I fired property managers on these first few deals. They didn't all work out, but some did, some didn't. It is harder to find consistent management in the smaller space, primarily because people aren't on site. It's not a knock on any management company, but it's harder to manage stuff when you don't have on-site personnel dedicated to your property, which is essentially impossible significantly below the 100-unit range.
Yeah. Well, I have another question for you, Will. Where is Matheson Capital at today? And where do you guys see yourself going here in the next 12 to 18 months?
So today we have approximately $100 million of assets under management. This year alone, we've done over $50 million of acquisitions. Where do we plan on going in the next 12 to 18 months? The goal is always the same. The goal is always to do more. We're analyzing properties every single day, looking for the next opportunity. So the goal is just more. I can't be any more specific than that.
Well, I appreciate your honesty. Will, where can people hear more from you, connect with you, and find out more about Matheson Capital?
The best places to connect with me are probably, the best one is probably LinkedIn, Will Matheson. I'm reasonably easy to find. And alternatively, if you go to our website, which is mathcap.com, mathcap.com, you can join our mailing list. If you do that, you'll get an instant email that essentially invites you to schedule a call. I try to connect with everybody who joins our mailing list so I can talk to them, see how we can potentially work together, what type of help we can give. So those are the best two, either LinkedIn or mathcap.com.
Very nice. We'll make sure that those are linked down below. Will, thank you so much for taking the time to share your career and Matheson Capital's journey.
Thank you for having me, Trent.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.